and welcome to our conversation today. First things first, a few weeks ago, I found out that with about 8,500 shillings, you can actually own your own home, meaning you can pay a mortgage of 8,500 shillings. And that's why I'm here today. I've taken this topic so personally because I believe anybody now can have access to your own home. For many years, many of us have not been able to own a home because the interest rates are so high, properties are expensive. But if you do your research well, especially on the property side, you can see that there's property that's even available for 1.7 million, even 1.5. So why pay rent when you can actually own your own house? And that's the conversation we're having today. And with me is Geoffrey Maura. Geoffrey is the head of credit at Kenya Mortgage Refinancing Corporation. Geoffrey, thank you so much for joining us today. What is KMRC? For somebody who has never heard this name, what is it about? Demystify that for us.
Thank you, Torian. Kenya Mortgage Refinance Company is a PPP. This is a private public partnership, and a deposit-taking institution that was formed primarily to bring affordability to this market. So it's a wholesale financial institution which works with partners, that is banks and saccos. And the unique feature is that these banks and saccos are shareholders. So they participate in this program, and with that then they are able to access funding from KMRC and lend out to their customers. So that is how KMRC works in this market.
Mm-hmm. So, I mean, we're all excited to hear a little bit more about how we're able to shift from paying rent into owning our own homes. How does that work?
Actually, when you look at what we are putting in the market, is that rent Yako ni Keja Yako. Means that the rent you are paying today, it's actually can equal to your monthly loan repayment. For instance, if today you are paying 20,000, that's can already afford you a 2 million mortgage. Because the rates that we have brought to this market, they are fixed rate, long term, because we are talking about 25 years. Fixed rate, you are getting an average rate of between 9 and 9.5 from the participating institutions, and it is fixed for the tenure of the loan. So that gives you affordability. You are able to plan your income, and therefore you should not continue paying rent if that rent can be converted into home ownership. Mm-hmm. When you look at home ownership, it comes with benefits. Because for the interest that you're going to pay for your mortgage, it's actually tax deductible, meaning that you're going to save on the tax that you're paying. Who wouldn't want to save on tax? I mean, that is just money that it goes, and sometimes you don't see the return on the spot. So if you're going to save on tax, then that is a benefit. So the maximum interest you pay on every month, that is accumulated, and it is actually deducted from your income, and therefore you don't pay tax on that. Mm-hmm. That's a very big benefit.
I want us to talk about the numbers a little bit. And because when we had the conversation on Twitter, a lot of people were saying, so I earn X amount, or I found a house worth 3 million or 2 million or 5 million. How much do I get to pay per month? Can you just break it down a little bit further?
Actually, if you want to get a simple calculator, you just look for every million that you're going to borrow, you'll pay an average of 8,500. Because here we are talking about a fixed rate, 9.5% for 25 years, and it is fixed. Mm-hmm. So calculate, everybody can just do their own calculations. Mm-hmm.
So
every million, so 3 million, just multiply 8,500 times 3, around 25,500, mm-hmm. and you're there.
And who qualifies for it?
Kenyans earning below 150,000 per month are actually our target market. And the reason why that is so is because we are addressing the mortgage gap in this market. When you look at the mortgage gap, out of a study that was done by World Bank and the government of Kenya in the year 2016-2017, it was established that there are different stratas of Kenya's population. And when you look at the lowest being the socio, those are Kenyans who ordinarily will go for rentals, and they are looking at decent housing. So government is doing a lot to address that by upgrading the slums, and the government plays in that space. The next space is low-cost housing. We are happy that in the new dispensation, now there's a lot of focus on the low-cost housing. So meaning that there's now going to be an overlap between low-cost housing and the mortgage gap, because now we'll be able to address the two stratas. So the mortgage gap, these are Kenyans who are earning between 50,000 and 150,000 per month. So that is where the mortgage gap is, because majority of them can actually afford a mortgage. The only reason they cannot afford a home loan today is because of cost. So there are barriers. One of the barriers is the cost of credit, because if you're talking about 15-16% in the market, that is beyond the reach of most of Kenyans. So that's why we are bringing a rate that is within the single digit and also long term. Ordinarily, today financial institutions offer very short-term loans because they are looking at turnovers. They want to capitalize on that and also the risk of default. So if you bring in a long-term facility for 25 years at a fixed rate within a single digit, you have actually addressed that challenge of affordability. That's what we are calling affordable.
Okay.
Yes.
And when we say 150, and this is one of the questions that I've seen over the last couple of weeks, is that salaried? Must I be employed to be able to access it? Must I be in government to be able to access it? Or is just, anybody?
That's a very good question, because majority of Kenyans have not understood that. The way it is that we are looking at income, and we are using the word income, not salary. Meaning that for an SME, for an employed person, all of them earn income. So if you go to this institution, you'll actually be able to access the loans, whether you are self-employed or you are employed. They all play that. Whether you have a fixed contract, whether you are permanent and pensionable, whether you are doing your side hustles, as long as you're able to document your income, the financial institution will be able to analyze that and give you a credit score that will enable you to access the loans.
And you've talked about financial institutions, and I just want you to tell us a little bit more about that. Which kind of financial institutions have you partnered with? For somebody who's watching, where do they go?
KMRC, just to begin with, is a regulated institution because we play in the space of financial sector, and we are regulated by the Central Bank of Kenya. So we have certain obligations, and one of it is that the shareholders that we admit, or the lending that we do, we lend to institutions that are also regulated. So for the banks, they are also regulated through the Central Bank of Kenya. For the saccos, they are regulated through SASRA. So these institutions, by that regulation, then they are prudent lenders in the market. So they do their due diligence. They offer products that are accepted in the market because these are institutions that are reputable. So we are talking about 8 banks, 1 microfinance bank, and 11 saccos. It is a very unique model because for the first time in the world, this is the only mortgage finance company that has saccos as part of the participating institutions. And saccos play a very key role in this market because they have done what we call financial inclusion. They are able to address the financial needs of their members because they deal with members. And they are spread all over the country. So if you are in Isiolo, if you're in Malaba, you can actually go to a sacco and be able to access this funding. So these are the big saccos in this market who are able to do this kind of lending.
Yeah.
Yes.
And you've mentioned some of the counties outside of Nairobi, and I'm curious, all these loans, are they available to anybody no matter what part of the country they are? And perhaps as you answer that question, you can tell us a little bit about where the properties are. Where does somebody find these properties? Are there some accredited ones?
These properties are available throughout the country in all the 47 counties. And because we appreciate that the members of this institution that you're working with are spread across the country. And therefore, in whichever part of the country you are in, you can actually access funding, affordable credit from this institution. When you talk about the properties, we're talking about properties both from the private developers, self-construction facilities, or properties that also the government is partnering with the local government, the county governments to bring out properties that are affordable. You've seen a few of the projects that the government has done in Nairobi, in Mombasa, Kakamega, Kisumu, those are spread. And we are not just looking at only those properties. So if you have a developer who, a developer who is doing a property under the affordable housing space, you can actually go and purchase from them. Yes.
I want to ask a question about the requirements. What are there specific requirements that one needs in order to be able to qualify for these affordable loans?
From one institution to another, there will be different requirements. And you realize that Kenya Mortgage Finance Company does wholesale lending. So we are lending to their financial institutions so that they are able to on-lend to their members. And therefore, as one of the key features of this product is that KMRC is trying to standardize the mortgage origination process. So as part of that origination process, we have agreed on certain standards, underwriting standards that the institutions need to adhere to. And one of it, of course, they'll be looking at the income, that you need to document the income that you have as an applicant. The type of properties, also we are looking at properties that are built in a sustainable way. So sustainability is a key component in some of these properties. So if you are buying a property, you need to confirm confirm that the property is not in a riparian land, because then that will go against the sustainability. You have to buy a property that's not in a marshy area, in a flood prone area, because at the end of the day that will affect the security you are taking, because it's your property, and it will affect even the value of the property that you're going to buy. So there are certain requirements and criteria that has been shared with the 20 institutions, and they follow those guidelines. But of course, that's also, it's a requirement that when it comes to income, that you need to retain at least a third of your income when it comes to deduction. So those are some of the things that the financial institution will look at.
Geoffrey, you referred to this earlier, but I just want us to talk a little bit more about it, and that's on if somebody has a plot, maybe they bought a few years ago, and now they've seen, there is an opportunity for me to maybe even build a house. Do they have access to this affordable housing loans, and how do they go about it?
Yes, they do. They have access to the affordable housing loans. What they need to do is just to go to their institutions, their bank or their sacco. The property need to be titled. So we are looking at properties that have titles, and they'll be able now to discuss with the lender on the modalities. Of course, if you want to build your own home, I think the first thing is just to come up with a budget. You need to define a budget. How much do you need to spend on that home? Have drawings, so you need to have a discussion with an architect who will do drawings for you. You also need to have a discussion with a QS who will do bills of quantities. So they'll price the quantities so that they can tell you, for this kind of house that you want to build, it will cost you X amount of money, because that's where the budget. Then against that, then you'll be able to see can you afford and how much can you afford. In addition to that, there are certain things also you need to observe as a borrower. There need to be approvals that you need to obtain from your local authorities. And once you have all that put together, then you can now go to the financial institution and you have the discussions on your credit worth, and you start the journey towards home ownership.
Okay. Geoffrey, we have a lot of young people watching our conversation, and I'm just curious, what would you tell them? Because there's an issue of age. Maybe some people feel, I'm too young, or even I'm too old. So how can you address home ownership for young people? And if you feel that you're not young, but you are still within the brackets that you have mentioned, what encouragement or what would you tell them? What is the importance of home ownership?
In fact, home ownership is very important. It's a critical component of life, because when you look at the kind of savings you'll do, when you look at the equity, growth of your equity, because if you're to buy a property today worth 3 million, because that is what you can afford, and you are 20 years old, 25 years old, you've just finished college and you're starting life. In another 10 years, that property will be worth 15 million. And when you look at that, you've already created equity. You can actually now go to the financial institution, and within that equity of a whole 13, 14 million, use that money to borrow that money, and you go now and buy your dream home. So what it does is that it helps you to plan, financial planning. As you grow in your career, you're also getting to understand yourself better, And the best part of it is that when you're beginning life is that you don't have so many expenses. But as you go into family, as you go into career growth, your income starts getting many other, uses. And therefore, if by the time you're getting into family, you've already defined your portfolio, you've created a portfolio, it helps you because now you start getting cashbacks, because now you're able to access the equity you have created over time to now invest in other cash generation ventures. Yeah.
In a previous conversation, you talked about functional houses vis-a-vis dream houses. And I know for many people, you just want your dream house right from the beginning, right? Can you tell us a little bit about what the journey should be like, or what the ideal would be like, and what a functional house is and what a dream home is?
I think it's important, Rian, for us to understand that it's important to cut our coat to our sizes. And today, when you start life, it is important to look at where you are. We all aspire and we have dreams to own the best houses in this country. But we also need to realize, we have to look at the current financial realization. Let's start from where we are and we plan towards where we want to go. So the journey is that you start today with the amount of money you have, your income level, and you grow. So as you grow in your income spectrum, you're also looking at taking on additional responsibilities and additional investment options as you grow. So today, if you're starting with a small house, the functional house, you're looking at a house that is responding to your current needs. Because if you are one person or you have a young family, you don't need 5 bedrooms, for example. So start with your 1 bedroom, start with your 2 bedroom, and with that, let it sweat that equity. Sweat it to the point that it has created value for you, and therefore when you are moving now to a 5 bedroom, you are moving to a 5 bedroom because your family has grown to that size and it can no longer be accommodated within the 2 bedroom, and there is a reason, there is a justification. That's the way I look at it. Justify the investment so that it gives you value. There need to be value for money. Don't buy a property that will be idle and it ties you in your cash. And at the end of the day, and you've seen what is happening to some of us. The moment your family starts, your kids start going out, because now they've gotten to that age where they start now going to, have their own homes. You are left with a 6-7 bedroom house, and what do? You are just the 2 of you. You can't even occupy that house. So most of the old generation now are selling those properties so that they can go and occupy an apartment, because also they need a community around them.
That's true.
Yes. So you need to plan it in a way that it satisfies and responds to your needs at each and every stage of your life.
Mm-hmm. Geoffrey, we're almost coming to the end of our conversation, and I just want to get to emphasize a little bit more on the value, the proposition. Why should anybody take a KMRC backed loan and not just any other loan in the market? What are the benefits of it?
In your financial planning, I think you need to ask yourself, when I pay rent at the end of the month, if I stay in that house for 2, 3, 4 years, at the end of the day, have I created value for myself, or have I created value for the landlord? If you can use the same amount of money to create value for yourself by owning that property, in the 5 years, in the 6 years, you'll have created an equity that actually you can use to go and now buy your dream house. So start today by planning well so that you can start creating value for yourself. Don't enrich others. Use that money to create value for yourself. And the best way to do it is that convert that rent into your property. The rent yako ni keja yako. It can work for you. And it's possible in this market because we have brought affordability, long-term funding, and a fixed rate that was never there. Today, you've realized that banks have started sending notices that they are revising their interest rate for their loans because the inflation is gone up. The CBR rate was amended the other day. What does that mean? Is that for a commercial mortgage, it will actually increase, but a KMRC mortgage will remain at that rate for the tenor of the loan.
Guys, we have absolutely no excuse. So if you earn anything between 50,000 and 150,000, you can own your own home starting today. So follow KMRC on Twitter. The handle is at KMRC_CO. The website is www.kmrc.co.ke, and in it you'll also find a catalog of properties. So if you're looking for a property and you don't know where to find one, you can find that within the KMRC website. So that's it for now. I'd like to thank the Kenya Mortgage Refinancing Company for hosting us today, and I am looking forward to your stories of your home ownership journey. For now, it's goodbye and God bless.